So, welcome to the technical presentation for today. It's going to be a mixture today of technicals with fundamentals. My name is Peter Joseph, Senior Market Analyst at IronFX. In front of your screens, you have the US dollar index. It's the 4 chart. All charts to be presented are to be of the same time frame, unless otherwise stated. Now, for the time being, when with no time to waste, we note that the US dollar index has been on the rise on Friday, as it has been during today's Asian European session. It would be characteristic that we had a wide drop. This is the 1 hour chart, which was initiated practically on Friday's American session, dropping all the way and then correcting upwards. And during today's European and Asian session, it was a little bit higher. It's characteristic back in the 4 hour chart how it has edged higher than the 101.55 resistance line once again. Would have to correct the resistance line and turn it now into support line, given exactly that the price action has moved clearly above it. Let's go hunting for a new ultimate resistance line. At this point, I would be noting this peak here. Quite interesting. In red. And that would be the 103.95 resistance line. Locking it in. Let's also correct the labels. Starting with the S3, which is now being placed at 99.80. The S2 at 160.65. The S1 at 101.55. $102.45. R2 at 103.45. And the R3 at 103.95. Now let's talk a little bit about direction here. Now there were some guys which mentioned an upward trend line being formed, and it would be something like this. In my opinion, that remains unconvincing. I understand that there are higher truths, but I would like to see the price action actually forming a higher peak than this one. So practically, should the bulls take over, I wouldn't be surprised to see the price action aiming, if not even breaching, the 102.45. On the other hand, we have to note that the RSI indicator is on the rise. It's currently at the reading of 55.7. May imply the buildup of some slight bullish tendencies here. Note though that the price action is about to hit on the upper Bollinger Band, which may slow down the bull somewhat. Maintaining the picture on a technical level, a possible stabilization could practically allow the index to remain just above the 101.55 in a sideways motion. While for a downward motion, I would require the price action to drop, clearly break the S1 101.55, break the pre-mentioned upward trend line, and start aiming for the, if not even reach, the 100.65 support line. On a fundamental level, the situation is still quite tricky. And I would be noting that we had a number of releases over the past week, actually on Friday, regarding the US. Give me a sec. Now, we had the release of the US PC price index, which slowed down. And it slowed down both on a year-on-year as well as on a month-on-month level. I would be noting also that we had the the US consumption rate. Note also that the core CPI rate, core PC price index, slowed down but to a lesser degree, and that's the Fed's favorite measure, implying some involvement also from oil prices here. Personal spending ticked down. That was interesting. So I would expect more or less the US dollar to have weakened from the release. And it actually did. If we drill into the 1 minute chart, it should become more visible. Let's go back to Friday. It should be this one. Yep. There was some volatility of around 22, 23 peeps, maybe even a little bit lower. But it was characteristic how afterwards the US dollar, despite some corrections, continued lower before correcting higher once again. On a fundamental level, we note that there's still, back to the forward chart, there's still market worries for a possible recession in the US economy. And I think that the slowdown of the GDP rate exactly highlighted this scenario. That was on Thursday, where we saw practically the US GDP rate in a preliminary form actually dropping more than expected, slowing down more than expected, reaching 1.1% on an on an annualized basis. Let's confirm that. Yeah, here it was. From 2.6, it slowed down to 1.1. It would be interesting to see if there was any market reaction back in the 1 minute chart in the US dollar index at the time of the release. On the contrary, the USD was on the rise, about 30 pips at the moment of the release. Okay, that was interesting. Back to the forward chart. Now, don't forget that we are going to be having a full week for USD traders this week. And I would be highlighting definitely the Fed's interest rate decision on Wednesday, where the bank is expected to hike rates for 25 basis points. But I would be also noting the release of the ISM manufacturing PMI figure, which is due out today. And should there be a slowdown, that may imply more or less that we have intensified worries for a possible US recession. Good morning to Pappy here. Thank you, guys. And overall, I think the key events are going to be the PMI figures, the ISM PMI figures, both the manufacturing and the non-manufacturing figures. Definitely the highlight is going to be the Fed's interest rate decision, but I would also highlight the release of the US employment report for April, which is due out on Friday. Now, there we have a wide drop expected regarding the NFP figure, and we may see the US unemployment rate ticking up, which may enhance practically the messages to the Fed to stop hiking rates and could weaken the USD. For the time being, though, we see that on technical level the bullish sentiment seems to remain, and should that intensify, we may see the price action of the US dollar index rising and even breaching the 102.45 resistance line, a level which provides resistance here and here. On the flip side, should there be a stabilization, I wouldn't be surprised to see the price action of the US dollar index practically revolving around the S100 and 155 support line. While for a bearish outlook, we would require the price action to drop, not only break the upward trend line we have just mentioned, but to reach as low as the 100.65 in order to see a very clear-cut bearish outlook here. Okay, let's have a look at Euro USD. Now the main element here, despite some correction lower of the upward trend line, in my opinion, is that we have a break. We have a stabilization of the pair, and that becomes more obvious as the pair respects more and more the 1.1075 resistance line. We had mentioned this last week, and it actually happened. And I would be highlighting the sideways motion, which remains between the 1.1075 resistance line and the 1.0925. So once again, the sideways motion has been confirmed also by a breaking of the upward trend line. Note that the RSI indicator has dropped slightly below the reading of 50. It's actually at 45, which in my opinion tends to also imply a rather indecisive market. I wouldn't be surprised to see the price action remaining between the R1 and the S1. But just in a case basis, should the bulls take over, I would require for bullish outlook the pair to clearly break the R1 1.1075, a level which was providing difficulties for the bulls, was aimed for a couple of times, tested, but not clearly broken. And the price action has to rise, break the R1 1.1075, and this time I would require to start trading for the 1.1220. Also, a neutral above the R1 would be confirming a bullish outlook. In case the bears take over, say for example the US dollar strengthens, we may see the pair dropping, breaking the S1 1.0925, and start aiming for the S2 1.0760. Now the euro is in an interesting note as we had some mixed signals coming out from the zone on Friday. We had a number of releases which were quite interesting. And I would be noting that, give me a sec, practically we had an inflation HICP rates which tended to send out mixed signals. Say for example, we had the French HICP rate more or less implying that inflationary pressures are still strong. It's characteristic how the rate accelerated to 6.9% year on year. We're talking about the headline rate. On the flip side, Germany's HICP rate tended to tick down. Let's have a look at that. It actually dropped to 7.6 from 7.8. I would be noting also from Spain, which is a considerable market for HICP purposes, a substantial acceleration from 3.1 to 3.8, which in conjunction with the French one may push Eurozone's HICP higher for the month for April. And that's always on a preliminary basis. I think that should be out on Wednesday. Anyway, On the other hand, we cannot miss out on making a small comment also on the GDP rates. It was characteristic how the year-on-year rate in France for quarter one, the preliminary rate, accelerated to 0.8%, while we had similar readings also from Germany, which, okay, on the flip side, slowed down, yet that's a little bit contradicting in the sense that we had a correction of the comparative rate, and it actually reached stagnation levels that was a positive for Germany. While Eurozone's GDP rate slowed down from 1.8% to 1.3%, which definitely is not a positive for the euro. It would be interesting to have a look at what the Euro USD reaction, if there was any, at the time of the release. Let's go back. And that was on Friday. There wasn't much reaction. The time of the release was 2020. Yeah. Very slight drop. Nothing. 5 pips. Okay. So we have the ECB's interest rate decision this week. That's on Thursday. Definitely Euro traders on a fundamental level would be increasingly pivoting towards that release. At the same time, let's not forget that we have also Eurozone's preliminary HICP rate. And should the rates slow down, that may ease the pressure on the ECB. But given that we had already Spanish and French HICP rates accelerating, I would be doubting considerably whether Eurozone's HICP rate would actually slow down as well. At a possible acceleration, that may increase the pressure on ECB to actually continue hiking and at a rather fast pace. So that would be a big issue for Euro traders this week. Once again, Eurozone's preliminary HICP for April and ECB's interest rate decision on Thursday. For the time being, we have mentioned we maintain our bias for a sideways motion to continue, while for a bullish outlook we would require the pair to rise, break the R1 1.1075 and start aiming for the 1.1220. Mind you that we're drilling now to the daily chart. You can see that this level was not reached, the R1, since, and that was on the 31st of March last year. So we're talking about a 13-month high here. That may make it a little bit difficult for the bulls to take over. And it actually provides a more understanding explanation why the pair was unable to break clearly above the R1. On the other hand, for a bearish outlook, we would require the pair to drop, break the low boundary of its current sideways motion, the 1.0925 support line, and start aiming for the 1.0760. Let's move now to cable and GBP/USD. Okay. Let's readjust the labels a little bit. Now, the buy-side research tended to imply that there is here an upward trend line. Let me show it to you what they meant. It would be something like this. In my opinion, that's unconvincing. I don't seem to imply. I would like to see continuous rise despite the jump, which was mostly related to USD weakness rather than GBP strength. You can see how quickly within 1 day, the pair corrected below the 1.2540 once again. I would expect the sideways motion to be maintained. Let me insert So I would expect the price action to correct, maybe even a little bit lower, and remain between the R1, 1.2540, and the S1, 1.2350. On the other hand, okay, the RSI indicator is above the reading of 50, it's at 56.4, but it has been dropping, which may imply that slowly but steadily the bullish effect is fading away. On the contrary, I would expect the pair to remain in a sideways motion and the RSI indicator to remain near the reading of 50. Should the bulls take over, I would expect the price action to rise, break the 1.2540. I would like to see it making a higher peak than this one. And that may allow it to start slowly but steadily aim for the 1.2770. On the flip side, should the bears take over, we may see the price action dropping, breaking the pre-mentioned upward trend line, break the 1.2350 support line, and aim for lower grounds. Moving now to USD and JPY. By the way, we have to note on that on the pound side, give me a sec. Okay, it's a bank holiday today. Also in the Europeans, it's a bank holiday. So we may expect low volatility here. Okay, let's move now to USD and JPY, which has been on the rise. It's interesting how it has started to correct a little bit lower. But overall, let me readjust the chart a little bit here. Definitely this one has to be turned into a support line. And I would be noting that we have a lower resistance line here. $137 level, which provided resistance here and here. Let's lock this in before moving on. And let's go hunting for a new ultimate resistance line. Readjusting the chart. Let's go back. And we have a very interesting peak here. See how the R2 actually provided resistance here and here as well. So that's pretty valid. And this is the 142.25 in red. Readjusting the chart. Let's reposition the labels as well and correct them. The S3 is at 130.40, the S2 at 133.55, the S1 at 135.15, the R1 at 137, the R2 at 139.40, and the R3 at 142.25. Note how we have practically recalibrated the R1 in order to have lowered it in order to reflect this peak, but also these peaks and further back. The bullish sentiment seems to remain strong. It's characteristic that the RSI indicator has risen and at its peak had reached 85. That's far higher than the reading of 70, usually signaling bullish sentiment. But it's understandable that also the RSI indicator has started to drop slowly but steadily. It's now at 80. So we may be seeing a correction here, which may form a base for the bulls to jump even higher. And in that case, I would expect the pair to rise above the 137 resistance line, a higher peak than this one, and start aiming for the 139.40. Should the pair stabilize, I wouldn't be surprised to see it remaining just below the R137 resistance line. While for a bearish outlook, however improbable that may look, it's still a possibility and should be covered. I would require the pair to drop, break the 135.15 support line, and start aiming for the 133.55 support level. It's interesting how BOJ's interest rate decision practically pushed the pair higher by weakening the JPY. Now, despite BOJ not actually excluding the possibility of some tweaking of its ultra loose monetary policy, actually erasing the yield curve control policy. However, it transferred such a scenario into the deep future, which was disappointing for JPY traders. They expected, definitely not a radical overhaul of the bank's monetary policy, but at least allow for the possibility of a nearer alteration of the YCC at a faster pace. That didn't happen. Okay, let's move now to AUD USD. Sorry, before that we have still to see USD CHF, which remains in a sideways motion with some slight bearish tendencies. But overall, in my opinion, they are unconvincing. It's characteristic how the RSI indicator is just above the reading sorry, of 50. On the other hand, note that we're getting Switzerland's CPI rates on Friday, and the rate is expected to tick down, which may weaken the CHF side of the pair. For the time being, we note this level as the next ultimate resistance line, and it's being set and 0.9210. Let's readjust the labels. Okay. Now the S3 is being placed at 0.8760. The S2 at 0.8860. The S1 at 0.8935. The R1 at 0.9020. The R2 at 0.9115. And the R3 at 0.9210. We tend to maintain a bias for the sideways motion of the pair, which its price action is expected to remain just above the S1 or even revolve around the S1 as an axis. Note once again the RSI indicator, which tends to remain close to the reading of 50. It's actually right now at 52.4, implying a rather indecisive market, which once again may allow for the sideways motion to be maintained. Should the bulls take over, I wouldn't be surprised to see the price action of USD-CHF rising, testing for even breaching the R1 0.9020, which used to be more of a support line in the past. On the other hand, should the bears take over, I would expect the price action to drop, clearly break the S1 0.8935 and aim, if not even breach, the 0.8860 support line, which provides support here and here and here, but that was a brief one. For the time being, once again, we highlight the possibility of a sideways motion just above or around the S1 0.8935 and highlight as one of the key events the release of Switzerland's CPI rates for April. I would be noting also, though, that the general market sentiment could move the safe haven pair, given that CHF is also quite sensitive to market nervousness. Should there be an improved market sentiment, we may see the CHF weakening and allowing for the pair to rise. While on the flip side, should there be extensive worries, we may see the CHF taking the lead once again and the pair dropping lower. Okay, let's have a look at the Aussie. Now we note that the pair was able to at least briefly break below the 0.6625, which exactly highlighted the possibility of the pair dropping further, given that it had escaped its sideways motion to the downside, but slowly but steadily it crawled back up above the R1 0.6625, which forces us to actually switch it into support line once again. Let's go hunting for a new timid resistance line. Somewhere here. This peak here is interesting. And that would be in red. The 0.710. I know it's a rather long distance since from the R2, but symmetry is not one of my main concerns here. Adjusting the chart. Let's reposition the levels as well, and we have a small discussion to make about the Aussie on a fundamental level here. Starting with the S3, which is now being placed at 0.6390. The S2 at 0.6520. The S1 at 0.6625. The R1 at 0.6755. The R2 at 0.6855. And the R3 at 0.7010. Locking everything in. Let's discuss a little bit about direction. The RSI indicator has been on the rise and has just broken above the reading of 50. It's actually right now at 52.4, which tends to imply some stabilization of the pair. So a sideways motion, given also the breaking of the downward trend line, would not surprise us. I would expect the pair to remain, or if you prefer, revolve around the S1 0.6625 support line. On the other hand, though, should the RSI indicator rise a little bit higher, we may see some slight bullish tendencies here for the pair, and it may start aiming for the 0.6755. I would require a clear break or even a test of the R1 before actually switching my sideways bias in favor of a bullish outlook On the other hand, should the bears take over, I would expect the price action to drop, break clearly the S1 0.6625, and reach, if not even breach, the S2 0.6520. On a fundamental level, I would note the release of China's NBS manufacturing PMI figure, which dropped once again below the reading of 50, implying another contraction of economic activity for the giant Chinese manufacturing sector. And that may imply a lower amount of exports of raw materials from Australia to China. That definitely wasn't good for the Aussie. On a macroeconomic level, trader-wise, it didn't seem to matter much. Let's have a look at that. If there was up, it wasn't. There was no release. Okay, so that would be one. I think though that the main element of the week for Aussie traders is going to be the release of RBA's interest rate decision that's due out tomorrow during the Asian session. Now the bank is widely expected to remain on hold at 3.6%. That's not an issue, or not expected to be an issue. So should the bank remain on hold, then attention may turn towards RBA Governor Philip Lowe's accompanying statement. Should the accompanying statement show that the bank has more permanently paused or even ended its rate hiking path and plans to remain on hold, and that 3.6% of the official rate is suitable to actually combat inflationary pressures within the Australian economy, that could weaken the Aussie. And in that case, we may see the pair dropping below the 0.6625 and start aiming for the 0.6520. Such a comment, I wouldn't say dovish, but such a cautious comment may allow for some speculation for practically the price action, or if you prefer, for the market sentiment to start being established that we may see even some rate cuts by RBA. But for the time being, I wouldn't expect that, at least not yet. On the other hand, should the bank highlight that the Australian employment market remains rather tight, and at the same time highlight that there may be a possible need for more rate hikes as inflationary pressures seem to remain a little bit stubborn in Australia, that could push the Aussie higher and thus may force AUD USD to rise, reaching, if not even breaching, the 0.6755. For the time being, though, I would expect the bank to remain on hold at 3.6% and most probably maintain a more neutral stance in Governor Lowe's accompanying statement, at least for the time being. Let's have a look at USD CAD. Wide drop of USD CAD, that was on Friday. And we see that, let's drill into the 1 minute chart. It would be interesting to see what the market reaction was at the time of the release of Canada's GDP rate. That was for February. Note the negative gap at today's opening. There was no major market reaction. This was the moment. So there was a slight drop of USD CAD to 23 pips. Okay. USD proved to be even weaker than the CAD. It was characteristic though on Friday how we saw that the country's GDP on a month-on-month basis slowed down. And actually, if I'm correct, contracted, let me check that again. Yep. It slowed down on a month-to-month basis for February from 0.6 to 0.1%. No contraction, but still definitely not good news for the Canadian dollar and the Canadian economy. On the other hand, the financial releases of the US dollar related to the US dollar more or less were weakening the USD even further. That's why we see a deep contraction here of the price action of USD CAD, which interrupted clearly the upward trend line guiding it. So definitely we have to switch our bullish outlook in favor of a bias for a sideways motion, given that more or less the price action also respected the S1 1.3545 despite the small break here. I would more or less expect the sideways motion to prevail between the R1 and the S1 for the time being. The RSI indicator is just below the reading of 50. It's actually right now, let's have a look, at 46.9, which tends to confirm a rather indecisive market regarding the direction of the pair's next leg. Exactly could allow the price action to maintain a sideways motion. Should the bulls take over, we may see the price action rising, breaking the R1 1.3645 and start aiming for the 1.3810. While on the flip side, should the bears be in charge once again, we may see the price action dropping, breaking the S1 1.3545 and start aiming for the 1.34, which provided support here and resistance here. It would be interesting to have a look also on oil prices, given the positive correlation between the Canadian dollar and oil's prices, given that Canada is a major oil producing country. Let's have a look at WTI. Okay, WTI, despite a slight rise, it was forced to correct lower. So it remains below the 76.20 resistance line. And let's go hunting for a new ultimate support level. Actually, I'm going to be narrowing these levels. Let's go further back and have a second look on that. Okay, seems to be valid. However, this one could go a lot lower. Somewhere here. Okay, that would be interesting. Something like this. Okay, let's readjust the chart. Let's have a look. The R3, which is now being placed at 96.75. The R2 at 80.90. Sorry, that's 86.75. My mistake, sorry. 80.90, $6 lower, almost 7. Yeah, $6 lower. And the R1, 76.20. Let's turn this into support line. $62.25. 66.20. 71.65. Now let's discuss direction. On a technical level, there seems to be a clear break of the downward trend line guiding oil prices. However, that remains to be seen, but it could be so. See how the price action is actually testing the downward trend line, despite correcting lower once again. Should the pair remain in sideways motion, I would expect the price action to remain just below the 76.20 resistance line. On the other hand, we have to note the RSI indicator, despite hitting the reading of 50, it was able to drop below it. It's actually at 42.4 and may imply that there's still some bearish tendencies to come for its price. So that would be one. Should that be the case, we may see oil's prices once again taking a downward motion. I see that you guys in your comments are suggesting that we may need to have a recalibration of the resistance and support lines. I wouldn't say no. We have seen new peaks and new troughs emerging from the past movements, which may allow us to do exactly that. However, I'm going to be leaving that for tomorrow. Should the bears maintain control though, we may see the price action dropping and breaking the S171.65 support line. On the other hand, should the bulls take over, I would expect the pair to the commodities price to rise, break the downward trend line once again, rise above the 76.20 and start aiming for the 80.90. Actually, let me work right now on this. There's a resistance line here. The temptation is too big to change that. And that's the 76.80. And I'm definitely going to be readjusting also the support lines. $73.90. The second support line, I'm going to be placing it somewhere here. We have touches into the upside as well. So there may be a mid level here. That's the 69.10. And this goes higher here. And this show here. 64.30. And the last one being at 64.30. So that should sum it up from the day. For the time being, once again, we expect oil's prices to remain in a rather stable sideways motion, and for any of the pre-mentioned boundaries or a bullish outlook would have to see a clear break of the R1, while for a bearish outlook I would require to see a clear break of the S1. So that should sum it up from the day. From all of us here at IronFX, best wishes for solid trading.
Hello and welcome to another educational video. As part of our technical analysis series, we would like to look at trend lines. A trend line helps technical analysts determine where market prices are heading. A trader using technical analysis will utilize trend lines to identify and confirm market price trends. This is based on the idea that price trends. The trend line is nothing more than a straight line drawn between at least 2 or more points. An uptrend line has a positive slope and it's formed by connected 2 or more low points. In order to have a positive slope, the second low must be higher than the first. Uptrend lines act as support and point out the net demand it's increasing as the price rises. An increasing price combined with increasing demand is very bullish and shows that buyers are determined to buy. If prices remain above the trend line, the uptrend is considered solid. A break below the uptrend line suggests that net demand has diminished and a change in trend could be looming. A downtrend line has a negative slope and is created by connecting 2 or more high points. The second high must be lower than the first for the line to have negative slope. To confirm that the trend line is valid, at least 3 points must be connected. Downtrend lines act as resistance and demonstrate the net supply is increasing as the price drops. A falling price combined with increasing supply is very bearish and shows that sellers are determined to sell. If prices remain below the downtrend line, the downtrend is considered solid. A break above the downtrend line indicates that net supply is falling and that a change of trend could be looming. The trend line becomes more important and more credible as the number of price extremes that can be connected by a single line increases. The validity of a line that connects only to price extreme is questionable. Most often traders can take profits too early. It is best to stay with the trend until it breaks, avoiding the desire to sell too soon because the profit could be higher than originally anticipated. Thank you for watching.
Further ado, I'm just going to introduce to you the topic for today, gold trading. It'll be a gold trading strategy. Remember, the disclaimer is that everything in this webinar is educational in nature. Nothing should be construed as investment or trading advice. Okay, guys, I just want to see if where's my video? My video's here. Yeah, nothing should be construed as investment or trading advice. Please do your own due diligence before you guys trade. Okay. Now. All right. So I'll be introducing to you your host for today. Her name is Peggy. Right. So she has she's the newest member of the team here, right? Teaching you guys not only the live trading sessions, but also today's session, which is her own personal trading strategy. It's called a gold trading strategy, right? So she has passed multiple prop trading tests, right? Even more than me. Right, she has done it really well. She's part of the team here, which we are finalists for the best FX and best equity research in 2019, 2020, and 2021. Right, so she clearly has a really good strategy that has worked multiple times through the years. Right, I want to encourage you to take the time to ask her, as she explains it. Right, she explains it. Take the time to ask her. For the first half of this webinar, she'll be doing it. After that, about 20 or 10 minutes later, we'll be passing on the time to another member. His name is Keaton, right? He'll be sharing with you the fundamentals when it comes to trading gold, right? Because it's not only, you don't only look at the technicals when you're trading, right? It's important to look at the fundamentals too, all right? So you'll be blessed with the knowledge of two really good speakers today, right? So have fun, right? I encourage you guys to ask questions when you can, right? We literally have another screen open here to monitor the questions that come through. All right. Peggy, do you need trading view? Okay, just let me open trading view for you. Chart. So okay, so I'm opening trading view here in case later, right? We're going to refer a bit to trading view. Peggy, Okay. But anyway, I'll pass on time to you first. Okay, so if you want to open it, just click on. And then it should not this one, just close this off. Yeah, it will show over here. Okay. All right. Now I'll pass the time on to you, Peggy. Right. Have fun. Careful, don't trip this thing.
Hi everyone. Good morning, good afternoon, wherever you are. How you guys doing? All right. Okay. Today I'm going to share with you guys about my gold trading strategies. Okay. Let me pull out the chart. Um. All right. I think I did some bookmark here just for you guys to easy to understand. So actually my strategy, I'm only using EMA 100 and 200. So my EMA 200 is a blue color and EMA 100 is a green color. Okay. Okay, let me show you the example why I enter the trade. Okay, for example, let me see. Okay, usually I will scout, so I will look at H1 and then I will enter the trade in M1. Okay, so I go to H1 time frame. Okay, I just do some bookmark here. For example, okay, I want to sell from here. Okay, as you can see that this is a very big bearish candle, and then it's come from like resistance. You can see here. So when the H1 time frame close, I will go to M1. Okay, and then I wait for price to pull back, and then I will sell. Okay, I will show you. Okay, I will put a sell here. Okay, you see when it hits EMA 100 and 200 in M1, I will place the sell here. Okay, where I'm going to take my profit is gonna be here. Okay, you can see. Okay. Sometimes you can see that price it may reverse. So usually my lot size is very small. It could be 0.25, it could be 0.35 or 0.45, but it depends. I will put quite a number of number of trades like layer. It's called layer. So like I put here one, for example. Where is my like just now I put here, right? I might put somewhere here, maybe 3 order, and then I see that the price reverse here. I might put like 1 or 2 more here, and then I go back to M5. Okay, it's above EMA 100 and 200. It's okay. Okay, so after that I layer and then I wait. You can see price coming down. Yep. Okay, then it hits my TP here. Okay, you can see here my first order I entry at about 1995, and that's my second one is about 1998. So my TP is about 1988. It's about almost 1000 point or 100 point here. Yeah, so this is how I scout my goal. Okay, let me know if you have any questions, so I try to answer you guys. Okay, this is one of the example. Okay. Um. Okay. Okay, I will try another. Do you use only H1? Yes. if I scalp, I only use H1, which is I will wait until the H1 candles stick close, and after that I will go to M1 to wait for the entry. Okay, all right. Oh, okay, no problem. So usually close, you go here, indicator. You can go here, moving average exponential, or it's called EMA. Okay, you can just click to. Okay, and after that you go to here, the setting, input, the range you put 200. I always use EMA 200 in blue color, so easy for me. And then EMA 100, you change to 100. And then go style, you change to green color. Okay, how big the tick you can just like make it like slightly thicker. Okay. Okay, usually I only use these two EMA. And then for my RSI, I only use when I want to see like divergence, buried divergence, or bullet divergence only. Okay. Okay. I have another example for you. Okay, just now I've sell. Okay, for example, if I want to buy, okay, from this one, for example, okay, like for this example, I want to buy. I saw that there's a very big candle here. How should we understand image green and blue light? Okay, actually the color of the EMA you can choose by yourself. You can choose yellow, green, you can choose black color. It's up to you, but to me, I always use like EMA. I know if like blue light, I know it's EMA 200. If the green light, it's gonna be EMA 100. So it depends on you. If you like pink color, you can just use pink color. Up to you. Yeah. So to me, because I have been using, so I already remember. So my EMA blue color is 200, and then green color is EMA 100. Yeah, you can choose your own color. Yeah, doesn't matter. It's up to you. Okay, so you have to know how to release the candles stick as well. For this one, for example, if I want to buy, because I see that in H1 is all the candle is above EMA 100 and 200. Okay, and this one after 1 hour is closed. It closed with green color here. After close already, I will go to M1. So actually my strategy, you can scalp like whole day, but you don't need to like on the computer all the time. You can just maybe after you place the trade, and then maybe end of the hour, you can just check like whether the candle is called with either red and green or green, and then is as support or resistance or not. Okay, you don't need to like look or staring at the charts for the whole day. But usually if I take my like challenge, I can scout like whole day. Yeah. And no, I don't trade by using strategy like EMA crossover. No, I did not. I only trade which is show you guys. Like for example, just now the green candle is closed with the candle is closed with the green candle. So after close already, I will go to M1, okay, to find the entry. No, it doesn't matter. It doesn't need to like cross over or anything. Okay, for example here, just now it closed already. You just have to wait for the price to come back, like pull back, and then you take the buy. Okay, I show you. Okay, I already enter from here. But sometimes you have to keep in mind, you don't need to like place the order like very big lot, because sometimes the price it may just reach at EMA 100, which is green color, but sometimes the price is could come down to EMA 200 as well. So you might need to like you spare your lot size to like layer below, because sometimes if you think, oh, this strategy I'm really confident, you put like 10 lot or 20 lot, right? But sometimes if reverse maybe 2 or 300 point, your pot is might gone already, so you have to manage your lot size as well. Okay, because sometimes it could come until like a blue line, which is EMA 200. So but this one is come until EMA 100, so I played the trade here, the order here. Okay, and then you would think that where I'm going to take the profit. Okay, to me, take profit you can just take at the recently high, which is around 1893. Okay, and then you have a look here. Okay, and then here's our TP here. So from here we entered around 1887. It's go up to 1897. I think it's about 500 point, right? About 6 to 700 point, or 60 pip or 70 pip, right? A lot, right? For example, like if you put only one lot, you already win like 6 to 700 USD per trade. Okay, after I close the position, that's it. I don't look at the chart anymore. I wait until end of the hours, and then I see again where is the candle or the price heading to. Yeah. But sometimes not every day that is a good day. Sometimes the trade may not go the direction as you think. You might have to either put the SL, or you might have to cut loss, which is cut loss a little bit is okay. Have to keep that in mind as well. I show you another like buy already. Oh, okay. Okay, for like this is we're gonna get the SL here. Okay, I will show you the trade as well. Like if you can see from here, okay, we know that it's ending with the green color, right? Green candle, and then you think that price is might be around like support, right? And then we say, yeah, okay, our strategy we're going to buy, we wait to buy, right? So you go to M1. Okay, one of the thing you have to keep that in mind is that our strategy that we have to wait at EMA 100 and 200, and then we buy when the price is reverse, right? And then we're gonna take a trade from here. But if you look through EMA 100 and 200, the price and all the way below EMA 100 and 200. And then even you go to EMA M5, you can see that like the price between the indicator is very far away, so it's likely this one is gonna like the buy. Definitely this one we gonna get the SL. Okay, let's see. Okay, back to our strategy. So we say that okay, if price go up to EMA 100 and 200, we gonna sell. Okay, it touched already. One is I sell here. Oh, I buy here. Sorry, I'm gonna buy here, right? Because it's ending with green color, candle. Okay, I'm gonna buy. Okay, after you buy, it's already actually from like this price is around 1821. It's go up to 1823. It's only about 200 point or 20 pip, right? And then you don't want to close the trade because you think that your TP is gonna be here. You want to get a TP here. Okay. and then you hold, okay, you hold the position, and then the price keep coming down. Where is our SL? Your SL you just put here. So it's from 1x to 1 to here, it's about 500 point, or if you put one lot, you will lose about 500 US dollar. Okay, you hold, you don't want to close, so you hold. Okay, and then this trade you're gonna hit our SL, and then you can see why the price, you see why the price is like not reverse as is ending with the H1 candle. This one, if you trade for a long time, you tend to kind of like observe that when the price is below MA 100 and 200, even like M1 and M5, and then it really far away like this, is downtrend. Okay, so if I see like that, I don't put the trade. I will just, okay, this hour I see like that, I don't put the trade, so I wait for another hour, for another one more hour. Okay, so this trade be his SL. Okay, even those like we enter just now around here, okay, the price is shoot up, it's about 200 point, you didn't close because you think that you want to go until like hit your TP, but after that the price is reversed. One of the things that if you quick enough, you can like put your SL or maybe remove move your SL to break even. Okay, so when the price reverse, right, you're not gonna lose anything if you quick enough. Okay, because to me I'm scout, so I have my like EA for like close all position in one click, and then I also have an EA for like set my TP and SL in one in like at one, so I don't need to kind of adjust one by one by one, because usually I put my order is like could be 10 order, but my loss is about 0.25 0.35. Okay, this one we lose the trade. Yep. And then maybe at home you can try to get EMA 100 and 200, and then you observe how is especially in gold, it really respect EMA 100 and 200 very nicely. I will show you one more. Okay, for example, this one I show you already. Okay, maybe this one. Okay, one more is like you can see that this one is very big and you can say like engulfing bearish engulfing candle, right? You can see very big one, and then you know that it come from resistance, so the next hour you're gonna sell. Okay, so we go to M1, and you can see that when you go to M1, you can see that price is already below EMA, so we want to sell. Okay, but just now price is, we want to buy but price is below EMA 100 and 200, so that's why it's his SL. Okay, even though you go to M5, you can see price also below EMA 100 and 200 in M5. Yes, we want to sell, so we wait for the pullback or reverse. You can see. Okay, first one, I will place the trade here, and after that I will layer. When the price go up around this like area, I will put a few order here. Okay, okay, so my TP is recently low here. Okay, then hits our TP already, so our TP is around 1974, and then we enters about 1978, so it's about 400 point. Yeah, and then that's it, you close the position, you can go and do whatever you want, drink coffee, enjoy your life, and at the end of the hour you just come and see again, because sometimes I trade by using only my phone. Okay, I don't need to like be in the committee all the time. So sometimes if you lost you lose the trade, you tell yourself it's okay, like, you know, you learn something, right? And then you know that, okay, next time you're not gonna do again. And then yeah, and one is like you need to manage your lot size as well, so you don't have to put like 5 lot, 10 lot, because you're really confident. But if your pot is really big, you can, no problem, you can earn a lot as well. So it's up to you guys. Okay, this is how I trade gold scalping. For example, like every time you scalp about 3 to 500 point. Let's say if you put 1 lot, you earn about 3 to 500, like like maybe per trade, right? And then maybe one day you trade for 5 times, you can earn only 1.5k USD per day. I think that is good enough already. Don't need to be guilty, because we can trade like every day, because you know how to earn the money, right? Okay, this is one. And let's see if I can find like another one. Okay, after 1 hour analysis, we should wait for retrace or pullback on it. Yes, correct. Yeah, you have to wait either like retest or pullback on EMA 100 and 200 M1. But then you have to see also whether like the candle, it come from support or any resistance. If come from support resistance big with very big engulfing, bullish engulfing or belly engulfing, and then you can say 99% based on my experience, yeah, you will win that the trade. But sometimes anything possible, so you have to put your SL every time you trade. Okay, you just, it's up to you how much is your pot, because sometimes you can just say, okay, maybe this trade I can lose like maybe 1000 or 500, and then you just adjust your lot size accordingly to your pot size. Because sometimes, you know, they might have like a new came out from somewhere, which is, you know, yesterday you can see gold is go up a lot, right? I think because yesterday have like USD new, and then they also have like war. It's about Finland. They're joining the Russia, right? There's a war. That's as well. That's why all the gold is shoot up. Okay, and now gold is coming down. I think this one I have sell from this resistance. I still hold my trade from this one. Okay. This one I put a trade because I just saw that price is at already as resistance, and then in M1 sorry, in H1 there's quite like a big rejection from here, so I just put the trade here. But my lot size is only put 1 lot. Okay, and then my SL is 1000 point. Yeah, my TP is about 1819. Sorry, 2019. That's my TP for the trade. Okay, let me show you one more. Okay, this one I show you already. This one we lost this trade. How many I show you guys already? But never mind. Okay, for example, this one. Okay, this one you see that, oh, there is very big bearish candle, and then it's come from resistance. Okay, so here we go to M1. You always see the same pattern here. Already price below EMA 100 and 200 M1, even at M5, price is already break below. So we wait for them to pull back. Okay, and then you see. Let me see. Okay. I think this one you may not call the trade here, because the price is not reach EMA 100 and 200. Okay, sometime price is may go close. Okay, if you think that you want to put the trade, you can just put like small lot size here, because its price is only come around this, like this. Okay, not even like close, then you might miss the trade because you think that okay, price haven't reached EMA 100 and 200, right? But actually you can see that price is come around this one and then all the way down. So this one you might meet the trade. Okay, if price go until like that, okay, you don't trade when the price is revert here and then you sell. Okay, because that mean price is really go down a lot. Usually end of H1, the beginning of like the next hour, price should have like pullback or reverse, and then we will take the sale from there. But if like the beginning of the hour, the price is all the way down like this, you don't put the trade. Okay, because based on my experience, when the price is reversed here and then you put the trade, usually it will go up, reverse a lot. So you better don't put the trade here. You just wait for the next hour and then you put the trade. Go it now near ATH. So not many support resistance. Like it's good to try to scalp right now. I do okay. Just now I do scalp. I hold my it's eh oh sorry, I thought like why is coming out a lot. Okay, I hold my loss like positions in the beginning here. Okay, about 2x just now, and then I close at 2 21 2122 around here. I close one like one orders already, and then now I've scalped because I saw that price is ending with like red candle. So just now I wait at M1 and then I place the trades around here. My first order is around 22023 because it go here, right? It's here and then it's reversed up until here. So I layer. Okay, so my loss size it's around 0.28. I put about five orders, so it's about total is about almost 2 lot. Yeah. And then here, yeah, and then I sell. Okay. Yeah. So I sell and then my TP is at 2023. I think it's already hit my TP. This is my second order. Yeah. So to me, because now they have a major new or war, so I try to kind of like secure my profit, and then that's it. End of the day, it's my reverse. Yeah, that's how I scalp. Okay, so now let me know if you have any question, because if not, I'm going to pass to my colleague. So he gonna run through all the fundamental. Yeah, anything you can ask him, because if you trade gold, I do look at the fundamental as well. Usually I just use Forex Factory, only the website to look if there is any news about USD. Okay. Thank you so much, guys. Let me know if you have any question. If not, I will pass through to my colleague now. I do trade on new, but after the new release. Yes, I do. But just after the new release. Like, for example, if like the USD, the new came out is yesterday it's red, so meaning that the gold will go up. Yeah, just buy. Yeah, I do trade, but after the new release. Okay, but my lot size is very small. What pity for gold? Is it going to go up higher? Okay, for the fundamental, I think later you ask my my colleague. He can give you some idea what to expect about gold later. Okay, thank you so much, guys. Okay, I will pass to my colleague. His name is Ketan here.
Hi everyone. My name is Ketan, so I'll just take over the fundamental part of the presentation. All right. Okay. So I'll just bring it over to my slides. Okay. Okay. So here we are. Okay, so it's full screen now. Okay, guys. Okay, so here we are. So okay, Peggy has covered all the technical analysis portion of with regards to goals. So I'll be speaking to you guys about the fundamental aspects and what to look out for. Okay, so okay, this is just a quick overview of which are the major sectors that uses gold. So we obviously have jewelry, investment, central banks, technology. So jewelry takes up 55% of the market. Investment is 25%. So this relates to uh, hedge funds, financial institutions, and retail traders buying gold ETFs, gold instruments, gold futures, and also, sorry, physical gold. Yeah, physical gold and gold coins. And then central banks also, which buying physical gold as well, and technology, which is used for example, printed circuit boards. So all the conductors on printed circuit boards use gold as it's a very good conductor of electricity. Okay, so just a quick one. Okay, so let's talk about gold demand in 2022. Okay, 2022, there were a lot of key events that took place, and one of them actually was the uh, Russia invading Ukraine. So there was a major geopolitical event which uh, which caused a lot of central banks and investors to buy gold. Okay, so what we are looking at here in this chart, right? Okay, where's my mouse? Okay, right. Okay, you can see my mouse as well. Okay, so this chart is from the World Gold Council, right? Okay, so it's showing us illustrating the global gold demand from 2010 to 2022. So uh 2020 was actually like the lowest demand for gold in the last 10 years or so. And after that, gold has actually started, well, demand for gold has started to pick up across all the segments, as we can see: jewelry, fabrication, technology, total bar and coin, which is physical gold, and ETFs and similar products. And this one in, I guess I would call this pink, central banks and other institutions. So as you can see here, this pinkish square, this is the purchasing by central banks. So as you can see, since 2022, it has increased pretty significantly, right? This is due to a combination of central banks buying gold as an inflation hedge. As we've all known, 2022 was the year of inflation as well, with goods and services, commodities, all rising pretty high, utility costs, energy costs all rising. So central banks were buying gold as a hedge against inflation, and also uh, as a hedge against devaluation of their respective currencies. Okay, so here we just take a quick look at gold reserves. So the United States has the largest gold reserves, followed by Germany and Italy's. Okay, just a quick overview on gold production, right? Okay, so this is for 2022. So as you can see, China, Australia, and Russia are the leading producers of gold, together followed by Canada and United States. So this is important because as sanctions are imposed on Russia with regards to natural gas, oil, and other commodities and gold, including gold. So you can see all these sanctions have caused the price of commodities to spike, at least in the first half of 2022 in general. Yeah. Okay. Gold versus real rates. Okay. This is a chart that I like to uh, would like to describe in detail to you guys, because this is what helps me guide the direction of gold on a larger time frame. Okay, so what we're looking at here is the chart between showing the price of gold with respect to real rates. Okay, so the price of gold is in yellow and real rates are in black. Okay, so what are real rates? So real rates is actually the 10-year treasury bond yield adjusted for inflation. Okay, so if you look at a nominal 10-year bond yield, it will yield a figure and then that figure is adjusted for inflation, which will give us this real yield here. So what's important to note about this axis is this is an inverted axis versus the goal. So the reason it is inverted, it is to show that it is to clearly illustrate the correlation between goal and real rates. So you can see here gold price is from y-axis from $1,000 to 2,000. Real yields is inverted, so it goes from positive 1.6% to negative 1.6%. Right? Okay. So this is showing you, this chart is showing us the history of the last 10 years. Right? Okay. So we can see the close relation between gold is and between gold and real rates. Of course, it's not 100% correlation, but the correlation is tight enough for us to determine what is the direction of growth of gold, right? So clearly we can see here, okay, there's also periods where the correlation doesn't uh, is not as tight as we would expect it to be. So that's why we just have to be a bit careful. So between 2014 to 2016, although real rates were becoming less positive, so going from 0.8 positive 0.8 heading towards zero, gold was actually uh, coming down. Whereas from 2016 onwards, the correlation really began to tighten. So as real rates peaked at positive 0.8% and started falling towards 0%, meaning that they were becoming less positive and heading more towards negative territory, gold price started to rise. Now, this is because as as real rates become less positive, heading to neutral and finally negative, this implies that gold in this type of environment where real rates are becoming less positive and more negative, gold serves as a better hedge against inflation. So this is when investors, central banks, and other players will start to buy gold. Okay, so one of the real fundamental reasons for gold prices to rise is that it acts as a hedge against inflation, but under certain scenarios, right? And that scenario is when real yields start becoming more negative, or they become less positive in this case, and finally they may even break into negative uh, territory. And so as you can see from 2016 onwards, the correlation is pretty tight. So when the real yield hit 0% and started increasing to become more positive, that's when gold started to retreat as well. So the basic takeaway is as real rates become less positive and more negative, gold prices increase. And conversely, as real rates move from negative to neutral to more positive territory, gold prices drop. So in this scenario here, you can see the correlation is pretty tight and things really took off in about 2019. So real rates peaked at about, I would say probably 1.2% here. And then they started falling pretty drastically all the way to 0%. And at the same time, gold prices bottomed at about 1,200 and made a uh, steady climb all the way up to 1,500 before pulling back for a bit together with real rates and then moving up again. And of course, we had the pandemic uh, lockdowns and crisis going on in early 2020, and there was a big volatility in across all markets, right? Across all asset classes, bonds, equities, precious metals, and currencies. So during this phase, you can see that gold and real rates also were very tightly correlated. So as real rates move into deeper into negative territory, so did the price of gold rise up in tandem. And it's been pretty much moving together in tandem all the way till here. So what happened in 2022, despite the geopolitical event of Russia invading Ukraine, which sparked a demand for gold moving because it's a major geopolitical event, and gold serves as a safe haven. That's why we had a big spike in the price of gold at the start of 2022. But surprisingly, after that, why did gold prices collapse? Despite the a major geopolitical risk event taking place, gold prices actually started to pull back uh, after. This is because it can be explained by real rates. So this is the macro environment that we were currently in, or that we were in 2022. So after gold prices peaked, real rates started increasing. So this happened as central banks around the world started raising interest rates to combat inflation. So as interest rates rise, real yields were also rising. So as real yields move from a negative territory to neutral and finally into positive territory, the price of gold followed suit and actually dropped pretty significantly as well. And then after that, real rates have been fluctuating up and down, and gold prices have rebounded. So there's a bit of disconnect here, and some of it can also be attributed to central banks buying gold, as we saw in the chart earlier in 2022. Central banks actually played a significant part in buying physical gold. They were actually a big player for uh, for buying gold, and a lot of demand came from them. So, thus, one of the reasons why uh, gold prices rose despite real yields just fluctuating up and down around here for was is due to gold central banks buying gold. Okay, now we'll compare two charts. So we know that real rates, bond yields, and the dollar, the strength of the US dollar affects the price of gold, right? So what we have here is a chart of the US 10-year bond yield with the instrument XAU USD. Okay, just to note that this bond yield is giving the nominal bond yield. So that is to say that the yield that you see here, 3.35% up to 4%, 2%, these are nominal yields which are not um, adjusted for inflation. Whereas on this previous chart here, the line in black is illustrating the 10-year bond yield, which has been adjusted for inflation. Okay, so just take note of that. So as mentioned earlier, so this was when we had the Russian invasion, the geopolitical event of Russia invading Ukraine, and we saw gold spike up, breaking $2,000 for the first time in almost since middle of 2020. So this was a major geopolitical event that caused the price of gold to spike. And then because of inflation as well, as inflation started to rise uh, pretty pretty sharply, central banks around the world, led by the Federal Reserve, were aggressively raising interest rates as well. So as interest rates are hiked or increased, the government bond yields will follow suit as well. So the US 10-year bond yield started rising pretty sharply from about 1.5, 1.8% quickly to about maybe just closer to 3% here. And at the same time, the dollar index was also rising. So that is to say, the dollar index was rising in tandem with the 10-year bond yield, uh, which actually made real rates become more negative. So with a strong dollar and rising bond yields, the price of gold actually started pulling back pretty sharply, as you can see here. So this is the macro environment that we were in 2022, at least for the uh, first half to the third quarter, right? So this explains why the price of gold actually pulled back sharply despite a major geopolitical event taking place. So what happened? So as you can see, our yields pulled back. Every time yields pulled back here and here, the dollar also pulled back together. And that's when we had some relief rallies in the price of gold as well, right? So if you're able to identify, or if you were to track the 10-year bond yield and the US dollar and use that as a guide to see where they are heading together, it will give you a good indicator of what we can expect for uh, the price of gold. Yeah. So essentially, in the third quarter of 2022, that's when bond yields peaked and the dollar index peaked as well, roughly. At the same time, they both started to pull back. So bond yields were falling, the dollar index was falling, and thus uh, prices for gold bottomed and started rising sharply. So in this environment, we had real rates becoming more negative, and thus as they became more negative, the price of gold started to increase as well, together with central banks who are purchasing um, large amounts of gold as well. So, and this relationship has followed suit pretty tightly. So, as you can see here, we had yields starting to rise here together with the dollar index, and at the same time, gold started to, I would say, probably consolidate. And as yields started to fall, dollar index started to fall, gold pushed up again. Similarly, they fell. Gold prices fell as bond yields and dollar index pushed up. So similarly, if we look at the chart of the DXI versus gold, that relationship is illustrated quite clearly. So as you can see here, we have a very strong US dollar rising. What this is due to central banks, especially the Federal Reserve, raising interest rates very aggressively, which caused bond yields to rise, which caused the US dollar to rise as well. So this was a period where not only for it's not only you can trade gold, but you can also identify periods where the US dollar was gaining strength across probably almost every major currency pair. And at the same time, this was negatively impacting the price of gold till the dollar index peaked together with bond yields. And the dollar index actually has really dropped off uh, pretty sharply from its peak. So that means to say it has lost strength against all of its major, or actually against all of its uh, major currency pairs. And at the same time, with falling yields, this has caused uh, gold prices to rise as well. And similarly, just at the start of 2023, when we saw the dollar index bottom at about 101 and start to rise together with bond yields, we saw this pullback in gold as well. And of course, together with the banking crisis with in the US in the regional banks with what is it? Yeah, Signature Bank and Silicon Valley Bank, plus the um, banking crisis in Switzerland as well. Uh, Gold also became a safe haven asset when investors piled into. So as you can see, there was another event here taking place as well in March, middle of March, with the regional banking crisis in the US, together with falling bond yields, falling dollar index, which has actually provided the catalyst for gold to rise again. So moving forward, as bond yields, we expect the dollar index to continue falling. We expect bond yields also to fall. So that should help prop up the price of gold. Naturally, of course, nothing moves up or down in a straight line. There will always be pullbacks to the downside. There'll be pullbacks to the upside. But by looking at what the US Federal Reserve is doing in terms of its hiking cycle, so its monetary policy, looking at how aggressive they are with raising rates or they're pausing, and then tracking the price of DXY and also checking the direction of bond yields will help to identify trading opportunities for gold. So these are all on weekly charts, but of course, depending on your trading style and strategy, you can scale all of this down to a daily time frame, 4 hourly time frame, or um, in a 1 hour time frame. So this is how you can use the macro environment to determine uh, whether there is demand for gold or not. So I guess the key takeaway here is to look at what central banks are doing in terms of actually, especially the Federal Reserve, what they're doing in terms of monetary policy. Are they still aggressive? Are they tapering down? So as you can see, the last rate hike by the Fed, they only raised 25 basis points. So they seem to be pulling back and becoming less aggressive. And at the same time, we've uh, seen that being reflected in the price of the dollar index and the direction of the bond yield as well. So when you can expect that um, the Federal Reserve is going to be less hawkish, we can probably say that bond yields are likely to fall further. The dollar index is likely to fall further, which means that real rates are becoming less positive and perhaps more negative. And then that would be a scenario where gold is in demand and will move up as well. Right. So that is what I have today for on the macro or the fundamental aspect of gold. So if there are any questions, feel free to answer. Feel free to type and ask away. Right. Okay. I'll just give 1 or 2 minutes and see if there's any takeaway or any questions for gold. Okay. Okay. Right. Okay. Right. I don't see any questions coming in. So, all right. Thank you everyone for your time, and I hope this has been any prediction the price will go up. Right. Okay. Given the current macro environment, it does seem that gold will remain elevated and is likely to move higher from here. But of course, you would have please do your own due diligence, be it in terms of fundamental analysis and technical analysis. But just my personal opinion now, gold is likely to stay elevated and could be pushed higher as well, especially if the dollar index continues to fall, especially if bond yields start to fall. Right. Okay. There's a question here. Will there be a recording of this webinar that we can access? Okay. I think so. Just let me confirm. Just give me a second while I confirm. Hang on.